So I'm going to start the recording process and we should be ready to go. So again, good morning, everybody. I appreciate your willingness to try something new and look at technology and a little bit different delivery format. So I want to start out talking a bit about the fundamental analysis. So when we think about looking at markets and trying to anticipate what's happening as we move forward in time, there's kind of two different philosophies of how to do that. One of them is and I'm going to talk about the bookends. I'm going to talk about the wide range of things that are done. On one end of the continuum, we have fundamental analysis, and that's typically looking and focusing primarily on supply and demand conditions. So we're looking at the size of the US crop, how many acres are we going to plant. We talk about the size of the South American crop. We talk about exports. We talk about crushing demand in the case of soybeans. On the other side, there's another kind of set of tools that have been developed and used by a lot of traders and analysts called technical analysis. The technical analysis part, which we'll talk about later on today, really focuses on the price movements. We're looking at historical price movements as a way to be able to anticipate or get a better read on what is coming next. Again, nobody has a completely good picture of what's going on. Nobody can forecast the future. However, we tend to have certain patterns. We have certain habits of behavior, and these charting techniques often pick up these human behavior, or these patterns that we tend to repeat over time. So when you talk to professional traders, when you talk to people that are in the marketplace on a regular basis, they often use a combination of some fundamental analysis and some technical analysis as they're trying to gather information and try and put together their best expectations about what they think will happen in the future. So again, I want to emphasize none of these techniques are perfect. Nobody can forecast the future, especially in today's world when things are changing so rapidly. But we do have some tools, we do have some techniques that can help us do a better job. And again, in today's session, what I'm going to try and do is combine a description of the technique with what's actually happening today, and again, hopefully have a discussion and be able to answer your questions about what might be coming next. So when we talk about fundamental analysis, one of the things that we are very fortunate to have, before I jump in, I did want to give a real quick brief background. Now, we are seeing, obviously, coronavirus, or the COVID-19, is dominating the news. It's dominating the news not only in agriculture, but also in the equity markets and the energy markets. This is Johns Hopkins University puts this together. They basically give you an idea of where are the current confirmed cases of COVID-19. And obviously, as you can see, there are cases in almost every country in the world. The United States right now is the hotspot. We have the most confirmed cases. And a portion of that, of course, is because we have a better testing system. Even though it's not perfect, we are trying to do a very good job of tracking how many new cases we are, and again, getting a better read on where are hotspots within the US. But this is a global issue. This is a global pandemic. This is something that's impacting almost every country in the world. And that has implications not only short term for what's going on today and some of the supply chain issues that we're starting to run into in agriculture, but also longer term when it comes to the economic recovery. Because there's been considerable slowdown in economies, not only in the US, but also in Europe and China, are a major concern for a lot of people. Each of the countries are having a little bit different response on how they're dealing with financial stimulus, how they're trying to deal with the medical issues, but also the economic issues. So again, I'll try and cover some of those as we're moving through. And again, if you have any questions or comments, please, feel free to chime in. Now, whether you like it or not, one of the things we do have in our benefit here in the United States is we do have a pretty good reporting system through U.S. Department of Agriculture, USDA. And every month, USDA puts together not only historical information, but also forecasts or projections for supply and use of the major commodities. This is in the WASDE report, the World Agricultural Supply Demand Estimates. And today we're going to focus primarily on soybeans. I do have a few slides on corn if there are some questions about corn. But I wanted to go through the layout of this table so you have an idea of where does the information come from, and let's look at what's going on today and how USDA is adjusting their forecasts based on the new information. Now, in many cases, private analysts, the companies that do their own forecasting, will put together their own numbers. But in most cases, the markets follow what the USDA, the USDA information carries more market weight than some of the private analysts. And there's a couple reasons for that. Number one is that they do have the largest number of people that are involved in putting this information together. USDA is a massive organization and has a lot of very, very bright people trying to do the best they can to forecast not only pricing, but also forecast both production and use. Again, we can be critical of that. We can question how they're doing it. We can question why they're, how their process and procedures. But I do want to emphasize that in my view, and I think in the market's view, USDA is probably doing the best job of all the market forecasters. And part of it is it's free information. It's information that's available to everybody at the same time. But also, not only is it a large organization, but they're also very transparent in how they do their job. Okay, so I'm just muting a couple people here. If you were to ask private companies, how did you come up with your particular forecast? In many cases, they would say, well, I'm sorry, that's privileged information. You know, that's something we can't share. But in the case of USDA, we don't know the exact formulas they use, but we know the process they use. We know the system they use to gather information, the system that they use to cross-check the information. They're very open and honest and public about that. So if we do have questions about how they're doing this, again, the process that's being used, we can look that up and we can agree or disagree. We can all have our personal biases, whether we believe the number is right or the number is wrong. But again, it is that common reference point. So I do want to go through this table very quickly, and then we'll talk some more specifically about the numbers and the current USDA forecast, which is on the far right-hand side in blue. And we'll talk a little bit more about how that might change as we move forward. Again, particularly how our US economy is starting to adapt to the coronavirus and the issues involved with that. So just to describe the layout very quickly, the top half of this chart, and hopefully you'll be able to see my cursor, the top half of this chart talks about the inflow of grain, our total supply. We got three major sources of supply. We have the carryover stocks from last year. We always have some grain left in the bin from the previous year that we can carry forward. We have the current year's production. And then in the US, our imports are relatively small, but we do have a small number of bushels that are imported to come from another country. So that provides, again, our estimate of total supply, the amount of grain that's available. On the bottom half, we talk about the usage. Now, in economics, we talk about demand. And again, loosely defined, demand is the willingness and ability to pay for something. So measuring demand gets to be tricky, but we can track, because of the flow of grain, we can start tracking where is our grain moving to. That's why we call this, instead of calling it a demand table, this really is tracking usage. How do we use up the crop that's been produced and the bushels that are available? Now, again, USDA looks at some major categories. They're looking for just kind of big buckets of use. So in the case of soybeans, our big buckets for use would be crushing, exports. We do have some seed. Again, some of the crop is held back for seed. We've got this thing called residual, which I'll talk about shortly. So let's start at the top. Let's see if I can get, there we go. Let's start at the top now. Oh, let me go back up. So the top half is supply, the bottom half is usage. On the far right-hand column in blue is the April forecast, the April estimates for the old crop soybeans. So this is the soybeans that we have in the bin. Now, all of these numbers are based off of a marketing year. So the marketing year for corn and soybeans starts on September 1. And usually what happens is we start the marketing year just before harvest begins. So harvest for soybeans and corn typically begin in earnest in probably October. So what happens is USDA takes a survey of inventories just before the crop year begins. And again, the reason they do it just before the crop year begins is because if you're going to take an inventory, the most accurate inventory you can take is usually when the warehouse, or in this case, the bins, are empty. Because if the bin is empty, it's a 0. So if you're going to try and get the most accurate estimate for what are your available stocks just before harvest, it's a lot easier to do that when the bins are empty. So they take a survey and this is a survey of not only farmers, but also of industry representatives or industry companies. Say, how much grain do you have in inventory just before harvest? We add in our production, we add in the imports, then we have a pretty good estimate of what the supply is. Now, again, the supply, earlier in the year, when USDA first starts forecasting total supplies, especially on the production side, we're estimating how many acres are going to be planted, how many acres are going to be harvested, and what the yield is. As we move through the season, the process that USDA uses to come up with those numbers, to forecast those numbers, changes and is modified over time. And again, as we get closer to harvest, obviously the accuracy increases, but we also have some other ways that we can double check the information. And I'll talk about that in a little bit more detail in a moment. The bottom half, again, that's usage. Again, what we're forecasting is the total amount that will be used in these different categories for that full 12-month period. And obviously, when we first start making forecasts, all of that's based on history. It's mathematical forecasting based on historical information and what we expect to happen within our economy. And as we move through time, those estimates become more and more accurate because we have more and more information about what actually happened. So let's just do a real quick recap of, again, what happened last year. We harvested about 75 million acres. This was actually a lower, it was been reduced since the December. I'm kind of using the December estimates as that reference point. Yield was increased from the December estimate. So we kind of had this trade-off. Our harvested acreage dropped, but the average yield went up. And I know a lot of farmers were very critical of that increase in yields, but actually makes some sense because some of the unharvested acres were going to be those acres that had the poorest production. I mean, if it had some drowned out or if it had very low production, you're going to start harvesting your best acres first. Now, in an effort to try and make sure that the numbers are as accurate as possible, typically in December is kind of the last formal estimate for yields as well as for harvested acreage. So when it's reported in January, kind of those become the official final numbers. Well, unfortunately, this year we had a lot of unharvested crop. We still have some here in North Dakota. So USDA said, well, we're going to resurvey some of the key states. Now, for soybeans, there was really 3, Michigan, North Dakota, Wisconsin. For corn, there's 2 additional states, including Minnesota and South Dakota, that we're going to be resurveyed to make sure that these numbers are as accurate as possible. Now, in this April update, when USDA came out with the April forecasts, they announced that they were going to start resurveying farmers in South Dakota, Minnesota, Wisconsin, and Michigan for both their corn and soybean acreage, both harvested acreage and yields, again, to try and get as accurate as possible, knowing that not everything was harvested the last time they did a farmer survey. They also announced that they were going to hold off or wait to resurvey North Dakota farmers until a little bit later in the spring, because at least when it comes to corn, we still have about, well, just a little under 20% of our corn still left in the field. And so again, these are the numbers based on the survey that was conducted in December. We will get an update here shortly, more than likely in May, because then we'll have, again, the Minnesota, South Dakota, Michigan, and Wisconsin numbers. So, again, just be patient. These numbers may be adjusted slightly as we move forward in time, but for right now, these are the numbers that again, USDA is using, and I think is the one that most traders and analysts are using. So pretty simple math. You take harvested acreage times yield, you get the forecast for total production. And again, in the case of soybeans, total production in 2019 was down about 20%. Most of that was because of delayed planting or prevent planting. And again, a large portion of that was in the Eastern Corn Belt. This is not major news, but I did want to go through kind of the process. So early on that year, early on in the season, what USDA does is they take, again, a survey of farmers' planting intentions. We'll talk about the 2020 numbers in just a moment. They take that harvested, planted acreage, they reduce it by kind of a historical average. They take that times a trend line yield. And again, a trend line yield is just the average yield that's been adjusted for technology, adjusted for time. Farming practices are getting better and better every year. And now as we move through the production season, as the acres are actually planted, as we get into the crop development stage, the process USDA uses to forecast yields as well as to forecast planted and harvested acreage changes a little bit. They are able to get more information, usually from using satellite imagery. They use, again, the satellite photos, the NDVI, the vegetative index, to try and look at plant health and use some of the information on the plant health to refine their forecast or estimates for yield. But a lot of the information that comes in is really relying on farmer surveys, farmer assessment of what do you think your crops look like. And again, I know farmers have been very critical of USDA's process, but it's the best we have, and again, we just got to deal with it. So I want to talk a bit more time about the usage side, because right now with the coronavirus, the real big questions are not typically on the production, it's more on the usage, on the consumption. And how is this coronavirus going to impact not only short term, but also longer term, impact these forecasts of usage, not only for the 2019 crop, but also for the 2020 crop. So again, I want to try and provide some historical perspective on how do we use up soybeans? What are the major uses for soybeans? So the blue line on top is crushing. Again, for this year, for 2019 as well as 2020, the forecast is crushing is going to be our major primary use. We're going to crush more beans than we're going to export. The red line is the exports. Now you can see the trend line for exports going back, probably into the mid 2000s, was, with the exception of a couple of years where we had some production issues, was pretty much a straight line until we hit, this 2016, 2017 time period when the trade war began with China. And again, I'll talk a bit more about China and Chinese exports in just a minute, or exports to China in just a moment. So because of this, of the ramifications of the trade war, our exports last year dropped significantly. The current forecast out of USDA, given the pace that we're at right now, is that our exports, total exports for the year, will increase slightly. So these dotted lines on the far right-hand side represent the current USDA forecast. So as we get more information, these forecasts will start to be updated and revised. Now for crushing, we crushed, obviously soybeans go into a crushing plant, crushed into oil and meal. Meal is primarily livestock feed, and again, what's happening within the meat sector and livestock industry right now is of a concern to a lot of people, but also on the oil side. So crushing into oil and soybean oil and meal. A lot of the soybean oil goes into the frying industry. So we use it for frying French fries, for frying potato chips. We use it a lot for salad dressings, for margarines. And about 30% of our soybean oil currently goes into the biodiesel industry. And again, with the cutbacks now that are going on in the energy sector and the falling energy prices, which is nice from a farmer's standpoint, but it's also having an impact on soybean oil prices as well. So right now, the current forecast is for total crushings to increase slightly from last year. Total exports to also increase slightly, But again, these are all based off of kind of historical patterns, and we're in a very unusual time right now. So I want to go into some of the numbers just to give you a better idea. What are some of the market analysts and traders talking about when it comes to not only meal demand, but also oil usage, soybean oil usage, as well as exports, and what our export outlook might be. Give you some better ideas, I think, on timing of when we might see a little bit of a recovery, especially on the export side. So if you look at the numbers, again, I want to use the previous years as kind of a reference point. So the blue is the current USDA forecast. As we look across, moving from right to left, we go back in time. So you can see that from a crushing standpoint, there's been this steady growth in crush demand. And again, it is a combination primarily driven by the demand for soybean meal in the livestock sector, not only domestically, but internationally, and also to some degree the oil. And again, on the sidebar comment, I don't want to get into too many of the details or nuances of the soybean meal market. I'm going to touch on a few things to just give people perspective. But approximately 25% of our meal is also exported. So meal exports are kind of a major deal for the crushing industry. Now, right now, today, crushing margins are very good. Unlike the ethanol industry, which is having some severe issues, crushing margins, when you look at the spread between soybean prices as an inbound cost to a crusher and the value of the meal and the oil, those crushing margins right now are still very strong. Now, there's some concerns as we move forward that might be changing, especially as some of our meat prices start to drop because of coronavirus issues. I'm going to talk about a couple more things, and I'm going to take a break to see if there's any questions, okay? So I do want to kind of in a global sense talk about exports and export pace. And again, we have had much higher exports historically. The trade war with China and the fact that China essentially stopped buying U.S. soybeans obviously put a major wrinkle in world trade and global trade. There were a lot of people that when we got this phase one agreement with China that believed that all of a sudden, the Chinese were going to come in and start buying a lot of U.S. soybeans. Well, in just a moment, I'm going to show you some seasonality. There's a very strong seasonal pattern in the U.S.'s ability to sell and supply the world market, and in particular the Chinese market. And by the time the phase one agreement was first signed and then implemented, because there was a delay in the implementation, we were almost past that big peak season that we had. So the current forecast, based on the current pace that we have for exports, as well as what we see going forward, again, based on the USDA forecasting, is for a slight increase in total soybean exports. And I know the marketplace has been waiting for Chinese purchases. China has come in and purchased some U.S. wheat. They purchased a little bit of U.S. corn. They purchased, I believe, a little bit of sorghum. And they have purchased some soybeans. Again, it's not a major amount, but they have purchased some. So I know that the market is anticipating China coming in a much bigger way, be much more aggressive. Hopefully that will happen soon. I guess I'll be happy to share my biases, but I do want to take a short break now to see if there are any questions or any issues that you want me to cover before we move on and take a deeper dive into this export market. So again, you can either type your question into the chat box if you want, or if you have a question you want to ask to the whole group, you can certainly unmute your microphone and ask the question at that point. I'm just checking the chat box here. Has anybody got any questions? All right, hearing none, I will keep plugging away. All right, so let me talk a little bit more about our seasonal export pattern. And some of you have obviously heard me talk about this before, but I do want to reiterate what's going on. I also want to show you the most updated numbers. So what happens here is this is a chart of the weekly export sales. So how many soybeans are sold each week. And again, these export sales are contracts for delivery in the future. So again, if for in an analogy, if you were to go into the elevator today and say, I want to sign a delivery contract for soybeans at harvest, we would count that sale today. So based on this chart, it's a matter of how much do we sell, even though the delivery is going to be sometime in the future. And the futures market, as well as a lot of grain traders, follow these export sales numbers pretty closely because it gives an idea of how many bushels have been committed. How many bushels have already been committed by international buyers for delivery later. And again, the delivery later part will have, or the timing of those deliveries will have a pretty significant impact on basis levels and what happens with your local markets. And again, Dr. Wilson will talk about that tomorrow. So you can see we have a real seasonal pattern here. If you look kind of historically, each one of those different colored lines represents a different year. The red line is the current 2019-2020 marketing year, so that's where we're at as of today. The black line is last year's numbers. You can see that the pattern last year was very different, primarily because Chinese buying and their buying habits had changed or shifted because of, again, the trade war. When you look at that pattern, again, we tend to have a lot of sales right at harvest. And the argument is, you know, if you're an international buyer, typically the cheapest time to buy soybeans is right off the combine. It's right at harvest. So if you're trying to book sales for future delivery, that's a really good time to come in. Now, once we get harvest completed, it kind of stabilizes. We have a drop off, but again, it stays relatively strong through the winter months. And then by the time we get into that February, March time period, all of a sudden things drop off again. Because typically by the end of February, first part of March, the Brazilians are starting to harvest their soybeans. They have, because of their climate, have a little bit more difficult time storing soybeans for a long time, for an extended period of time. And so the tendency is for the Brazilian crop to come to market very quickly, farmers selling very aggressively right off the combine just to try and keep it moving through the system. So it becomes difficult for the US to be price competitive as we move into that March, April time period, again, when they're reaching the peak of harvest. Traditionally, our export sales stay relatively slow through, you know, basically June, July, and into the first part of August. And what happens then by the time we get to late August, mid to late August, we start to see this transition or shifting away from the Brazilian supplies and back to the US supplies. And then as we get into that September and October time period, we get this big ramping up again. Now you notice that this year's seasonal patterns tend to be more normal. Unfortunately, the levels are much lower. And again, part of that was because of the delay in getting that phase 1 trade agreement with China signed. China did come in and buy some soybeans. I'll show you a chart in just a moment, but they were not nearly as aggressive this year as they typically were. So when we look at who buys US soybeans, and again, I tried to put some historical perspective here just for reference point. The far right-hand column is the 2018-19 marketing year. Again, that's last year's numbers. I use that because that is a full marketing year for comparison. You notice that as China, even last year, even though their purchases were very small in compared to historical numbers, they are still our #1 customers. So when you compare the volumes we tend to send to China versus our second largest customer, which is Mexico, and again, I'm going to come back to Mexico in just a little bit about this coronavirus and how Mexico is kind of adapting or adjusting to these concerns with coronavirus. But Mexico is our #2 customer, and then it drops off fairly quickly after that. And part of, again, the reason is that when we're using soybeans, if we're selling whole soybeans into the global market, we really need to sell it to a country that has crushing capacity. We need to sell it to a country that has the ability to take those raw soybeans and crush it into oil meal and use it themselves. And China is the world's largest crusher. I'll have a graphic here in just a moment to talk about that. So China is a very large buyer in the global market from all sources. They tend not to buy a lot of meal because of their large crushing industry. They prefer to crush the soybeans themselves. So if we start taking China out of the market, and this is, you know, I know I sound kind of like a broken record, but if we take China out of the market, that is one of our major, the major issues right now facing soybean prices is how quickly will the Chinese buying from the US return? Now, it's not to say we should ignore what's going on in Mexico. We need to try and service our other customers because we need that base to support those purchasing habits. When we look at who has crushing capacity, again, I want to put this in historical perspective. Again, these are USDA numbers. There are other private estimates. There's other actually agencies around the globe that try and put an estimate together. They're very similar to the USDA numbers, so I'm not going to belabor the differences in that. This just provides a historical perspective on the relative size. So again, in China, the dotted lines are the current USDA forecast for what their needs are in this current marketing year. You can see that the growth in Chinese soy crushing, this is not just what they're buying from the US, but this is how much soybean globally they're buying and crushing domestically, is a very, very large number. Again, largest crusher in the world. Number 2 is the United States, which is the blue line. Then we get to the purple line and green line, which are Brazil and Argentina. And so those top 5 countries dominate the crushing industry. So the challenge we have in soybeans, especially exporting whole soybeans, is we do not sell to China. Who do we sell to? And obviously, we're still using as much domestically as possible. It's very unlikely that we're going to sell US soybeans back into Brazil or Argentina for crushing there. So when we look at our alternative markets, if we're not going to sell to China, or if the Chinese purchases are very, very low, we really don't have a lot of other crush demand globally to be able to pick up the slack. And that was the problem we faced last year. And to some degree, that's the problem we're still facing this year. Now, we do export soybean meal. And I just, on a sidebar, I want to point this out. About 25% of our soybean meal is exported. And again, it's typically to countries that have a growth in their livestock sector, but do not have the crushing capacity. So when we look at this list, we have kind of the top 3, which is the Philippines, Mexico, Colombia. And notice now Mexico is also buying a lot of soybean meal from us. So not only are they buying raw soybeans, but also soybean meal. And again, it's primarily because of the growth of their livestock sector. We actually do export some meal into Canada, again, primarily for not only the hogs that we have in Manitoba, but also some of the beef as we get into Saskatchewan and Vancouver. Excuse me, into into the Western Alberta and Saskatchewan. So we do have export demand, but again, we need to focus on those countries that have this growth in their economy, but also the growth in their meat demand. I do also want to make a quick comment. One of our major competitors for soybean meal is obviously Argentina. Argentina is the largest meal exporter in the world. One of the things as we go through this coronavirus, and I want to bring it up right now for food for thought, is that this is putting a tremendous strain on economies. And the Brazilian economy, the Argentine economy are both coming into this coronavirus problem, were both on very shaky ground. They were financially not very strong. They're major agricultural powerhouses, but they're not necessarily strong economically. And so again, there are some real big concerns about economically, how are the Brazilian government going to deal with this? How's the Argentine government going to deal with this? One of the things they recently did was, because they had a change in their leadership, their president changed, they have now returned to increased export taxes. So there's actually an export tax on both soybeans, corn, wheat, as well as soybean meal and soybean oil. And again, the relative tax rate between raw soybeans and soybean oil, soybean meal makes a difference because they're trying to incentivize Argentina crushing their soybeans before it's exported. So again, they're not exporting a lot of soybeans as a whole product, but a lot of oil and meal. And again, this is just kind of a historical. I grabbed this from a USDA publication. They showed historically what have been the export taxes under the different administrations. And again, they're now returning to about a 33% tariff or tax on beef, They're returning to, on soybeans, returning to about a 30% export tax on soybean oil, meal, and raw soybeans. And then the corn number is at about, I think it was a 12 or 12.5%. So it looks like I have a couple questions that have come in. I want to make sure that I cover those. So let me go back up. One of the questions, will COVID-19 on the decline and beginning to return to normal in process, have they re-entered the trade world as quickly as transition seems to be taking place? And I assume that's referencing China. So yes, the pandemic in China right now, at least based on their official numbers, again, you know, some questions about what their official numbers are, but they are starting to lift some of their travel restrictions in China. They have been purchasing a lot of Brazilian soybean. In fact, some of the shipments that have been going from Brazil into China have been delayed, partially because of some port issues and labor strikes. Because of coronavirus, both in Argentina and Brazil, the people that are actually delivering the crop to the export facilities, as well as loading them on vessels. As well as there were some heavy rains. There was a period of some very heavy rains in Brazil, and they had some trouble loading the vessels and meeting kind of the quality parameters needed to be able to make the trip across the ocean. So what happened was the supply chain coming out of South America slowed a bit as a result, and strong kind of rebuilding some of that demand base through their hog industry. The Chinese did release some of their strategic reserves. So they were allowing some of the state-owned stocks and reserves of soybeans to be crushed domestically to try and fill that gap. Now, the Chinese economy is starting to rebound. They are starting to reduce their restrictions. There was a report out this morning about their export sales, and there was a drop in their total export volume, but the drop was not as large as a lot of the private analysts had been expecting. The trade guess was a total drop in Chinese exports. Again, these are products that they're producing and supplying around the globe. They were looking at about a 14 to 15% cut. The actual numbers that came out were about 6.5%, almost 7%, somewhere in that range. So the market was pleased with that. They were excited that, well, the drop wasn't as large as they had first expected. So tracking performance of the Chinese economy is always very difficult, but it looks like they're starting to recover. It looks like they have been buying soybeans off the global market. They've been trying to rebuild their hog herd. Again, primarily they've been using Brazilian soybeans to do that. So there's still a lot of unknowns. Some of the epidemiologists, the people that specialize in these kinds of viruses, are concerned about kind of a second bubble where once we start reducing some of these travel restrictions, that there'll be a second bubble of infections. Obviously, we'll have to wait to see what happens in China to see if that occurs or not. So it's a little bit early to tell right now, but it looks as though the Chinese economy was not hurt as bad as some of the private analysts and traders were expecting. So another question was, with the decrease in livestock futures, will animals be on feed longer, shorter, or stay on schedule? This may mean more feed demand if fed longer. Can packers increase process animal units? Can they increase the speed? Looking at this from a feed, meal, and corn and wheat, livestock costs increasing every day. So let me see if I can parse out. Yes, there are some slaughter plants that are now closing. You probably heard that there was a major slaughter plant, Smithfield plant in South Dakota, that closed. And they said closed indefinitely. I don't know, we'll wait to see. A lot of some of the private analysts are saying they're closing down, but they will likely restart, you know, once it looks like they've got this virus under control. There are other slaughter plants, both beef plants and pork plants around the United States, that are now closing, mainly because their workers are getting sick. So their supply of workers is going down. It's making it more difficult to make sure that you're staying current on your slaughter pace. The other issue, and this is kind of a legal one, is there are concerns now if you are an employee and your company has not done what is deemed to be everything possible to prevent the spread. Obviously, if you get sick or there's some deaths, there's this liability issue, and I know a lot of companies are very concerned about that, not being able to provide the correct social distancing or correct protective measures, especially in the slaughter facilities. It will for sure slow up. I mean, that now becomes the bottleneck, or that becomes the choke point for keeping our slaughter pace on schedule. There are some concerns that meat prices at the grocery store may go up because, again, shorter supplies on the outbound. We do have quite a bit of frozen stock available that we can pull off. Now, again, this is a timing issue, and I think we'll see some spot outages just because of the supply chain disruptions. One of the things that is also being allowed, and again, I'm not the livestock expert, Tim Petrie is, but the other thing that is being allowed is the rail rates, the speed at which the slaughter plants are able to run. They're allowed to increase those rates to try and get more product through. Again, there are some rules and regulations on how fast the lines could run. Some of those are now being relaxed to try and get more product, more animals through in existing plants. I know some of the plants will probably be going to multiple shifts. They may also be coming online during weekends and running some weekend shifts to try and keep the supplies up. So does this mean that the livestock will stay on feed longer? Boy, that's really tough to say as a national average. I do think there's going to be areas where that will be the case. Now, obviously, again, with the drop in prices, the folks that are either feeding cattle or feeding hogs are going to be very sensitive to profit margins and be looking for putting a lot of pressure again on their feed suppliers to try and get prices down for the feed that they're buying or the feed that they're milling themselves in their own mills. Will the decrease in livestock futures, oh no, I got to go on to the next one, I'm sorry. Will the United States come out with higher quality testing equipment? Does this potentially mean that we have seen the worst of the COVID-19, and with that, has the market bottomed out? You know, that's a great question, and I know that's something that everybody is trying to determine right now. What I have been saying for quite some time is that, in my opinion, I think that there will be downward pressure on agricultural prices in general, not just grains, not just meat products or livestock, but ag products in general, until it looks like the number of new cases is dropping. And it looks like that is starting to happen. Now, and there's already being talk both at the national level as well as state levels on the East Coast as well as the West Coast to try and work out a plan to start bringing the economy back online. Now, the answer to that, will prices actually start to increase? I think we'll see a psychological bounce just because if this is the peak, if it looks like the worst is over, I think there'll be a psychological recovery because everybody's gonna say, you know, at least it looks like we're in the positive rebound mode now. Will that recovery be very strong? How long will it last? I think is really the underlying question. And the answer to that is, in my opinion, really comes down to what are consumers going to do. Let's say we start to lift some of the restrictions. People start to go back to work. They remain social distancing, but they're allowed to have more freedom and being able to move around. You know, two questions: are we going to get reinfected? Is this going to have a second bubble in the United States? But will people actually go back to their habits, or are they so concerned about getting the virus and so concerned about getting sick or spreading the disease? You know, are they going to still refrain from going to restaurants? Are they still going to limit their exposure going to the grocery store? This is really going to depend upon how people respond to it, as well as how the states or the federal government decide to allow people to do more activities and we start to back away. So again, it's a little bit hard to know for sure. I do think we'll have some recovery just because it'll be a psychological improvement. People will feel better that the worst is over. But again, I don't expect that rebound to be really strong yet. Any other questions? I know that I kind of got sidetracked on a few things here, but I do want to make sure that I get the questions answered. Okay, so let me keep rolling then. And again, I'll keep monitoring the chat box, or if somebody has something, please feel free to jump in. I'm gonna go through a few more slides and we're gonna take a short break because I know you know, listening to this stuff after a while gets to be pretty tedious. So I do want to take a short break and let everybody kind of grab another cup of coffee and take care of their business. So a couple more slides and we'll take a break. Oh, excuse me. Let me get to the right slot. So jumping back in kind of this export pace, as we look at the pattern of Chinese buying, again, this is the same exact graphic I showed you before, but this is for China only. So you can see that again, as we got into our harvest period, there were a few large purchases, but since then, even after the agreement, the phase 1 agreement was signed and has been implemented, just because of the timing, a lot of the Chinese purchases have already shifted to the Brazilian market. Now, what's kind of interesting is the black line is what China purchased last year. And so you notice that this year, this marketing year, the red line, they went back to, again, much more of a typical pattern. So the shape of that pattern is more common, but again, the levels are much, much lower. Again, the question that everybody has on their mind is, when will China come back in the US market? And at what level will they start buying? There have been several questions about, given the flexibility in the phase 1 agreement, will Chinese live up to their commitments? There was an announcement a couple days ago that from the Chinese Trade Ministry that said, yes, they are still intending to live up to their commitments to purchase agricultural products. But they do, you know, they did caution that, again, given the COVID-19 and all the things going on, that there might be a need to re-examine that. Now, I don't know what's going to happen. We'll wait to see. And again, this is all kind of developing and evolving. My personal bias, I'm going to insert my personal bias here, is I do think that as we get into this June, July, or July-August time period, I'd probably say July-August time period, I do think China will come in and start buying some more US soybeans, but I think it's going to be very quiet until that point, simply because of the sheer size of the Brazilian crop. So I would expect to see in probably mid to late July some Chinese purchases of US soybeans, and then starting to ramp up those purchases as we move into the 2020 harvest. Oops, I got to again click on the right thing. So this is Chinese, again, purchases, but it's represented different. This is cumulative export sales. So every time that China buys something from us, we add it to the pile. So the reason I wanted to throw this in here is if you look at the total quantity that China has purchased this year, again, which is the red line, it's almost identical to the total quantity they purchased last year in 2018-19. Now, to me, that's kind of interesting, but the timing of their purchases was very different. Notice again that curvature, that kind of that arc that we see follows a more typical pattern, a more typical seasonal pattern. So even though the purchasing time period was different, the quantities, the total amount that they purchased from us have been relatively stable, about the same as they were last year. So again, we'll wait to see how this plays out. My expectation is, again, mid to late July is when we start to see some more purchases from China. I do want to talk a little bit about how competitive are we. Actually, this took me quite a bit of time last night to update this chart. So I pulled export bids. So this would be the price that an exporter is bidding for grain from the country. So when we think about the United States, when we look at the green line, which is the US Gulf, or the red line, which is US PNW, this is the price that the export elevators are bidding to elevators in the country, in the country elevator system, to be able to deliver to them. So there's some, when we think about export costs, so this is the inbound, this would be the price inbound to an export facility. And I'm comparing the US Gulf, US PNW, the black line is Argentine River Terminal, and then the blue line is Brazil, it's Paranagua, which is one of their large ports. Now, I know this goes back in time. I just wanted to show you some reference points that these tend to move very, very closely together. We did have some disruptions because of the trade war between the US and China. On the next slide, I zoomed in. So this is about the last 12 months. And I just want to show you that there are time periods. Again, you notice during our harvest time period, the price of grain delivered to one of our export terminals. So to get a price delivered to China, you have to add in the cost for handling that at the terminal, as well as the shipping cost, the actual ocean freight to get it to the delivered price into a Chinese port. But this gives us a general idea, are we priced competitively in the global market or not? Now, if you go back into this harvest time period, into the September, October time period, you notice that the US Gulf and US PNW were very competitive. We were the lowest price bid relative to what was going on in Brazil. We fast forward to today and we look at today's bids. Again, this is US soybeans versus Brazil and Argentina. The Argentine river terminals are the lowest priced. Now, again, they don't export the volumes that Brazil does. Brazil is a little bit higher in the blue, and then we're still several cents a bushel higher than they are coming out of Brazil, Paranagua. So again, this is an issue about trying to provide a competitive bid in the global market. So right now, the United States is really not price competitive with what's happening in Brazil, again, because of their harvest pressure and the fact that there's so many bushels moving to port right at this time period. So if you look at the bottom line, if USDA's numbers are correct, what is going to be our carryover stocks? How many soybeans are we going to have the bin as we start the 2020 harvest? And again, based on today's numbers, it looks like we're going to take our total ending stocks down considerably from last year, but please recognize last year's numbers were very, very large. They were not historically large, but very close to the top end of the range. So this will be one of my, let me just go to, yeah, this will be one of my last slides before we take a break. I want you to focus on those blue bars on the bottom. This is carryover stocks as a percent of use. So this is our stocks to use ratio. So if we take our ending stocks divided by total usage, what percent of our total needs are we going to have in reserve in case there's a problem in 2020? Now, notice 2018, 2019, last year's numbers were extremely high. Again, not record high, but very close to record high. The red bars, the current USDA forecast, we're at about 12%-ish for carryover stocks. If we look back before the trade war began, the typical kind of normal carryover stocks for soybeans was somewhere between 6 and 7%, and we're currently at 12. So the soybean market still has some issues. We still have some concerns about what's going to happen moving forward. So we're not out of the woods. I just want to jump, if I can, to one more. Please give me just a couple more minutes and we'll take a break. I want to talk a little bit about 2020. I want to transition from 2019 into some of the 2020 numbers. Again, the column of blue is the April USDA forecast. The red numbers are from the Outlook Forum. So this is USDA's first best guess at what's going to happen in 2020. And I just want to point this out and provide some context for what might be happening in 2020. Again, when USDA put these out in February, these are all mathematical forecasts. Since then, we've gotten some updated information. So what I'm going to do is take these numbers in red and update them for what we know today. And I'm not saying that this is going to be right, but I just want people to think about what might happen next year. So when we look at USDA Prospective Plantings Report, and again, this is a survey of about 80,000 farmers across the United States is saying, what do you intend to plant for 2020? And again, this survey was taken in the first part of March. So we've had some changes and shift in relative prices since then. But at that time, the top row is what the trade estimates were. That was the average trade guess. For corn was about 94 million acres. For soybeans, about 85 million acres. The red line in the middle is what actually came from the USDA report. So again, this is what farmers said. This is our planting intentions. Now, that can change. It can shift because of market conditions. It can shift because of planting conditions and what the spring looks like. But what farmers are saying is our intentions at that point was to plant about 97 million acres of corn and about 83.5 million acres of soybeans. So a bigger shift into corn and out of soybeans than most of the trade people were expecting. So if we fill in those numbers into the USDA Outlook Forum, if we take the 83.5 and then we subtract off, because there's going to be some abandoned acres, we use USDA's trendline yield of about 50 bushels per acre. We update our ending stocks. And again, I read, so whatever's in blue is numbers that I have updated. Whatever's in red came from the USDA during their Outlook Forum in February. So if we redo the math, given a larger cut in soybean acreage than we expected, and a little bit larger ending stocks based on the April forecast, we still see a reduction in total ending stocks for soybeans coming into the 2020 season. Again, now a lot of this information has already been factored into the marketplace. We do have some concerns about that large shift. And again, the corn market has been responding not only because of the forecast for increased acreage, but also some problems obviously in the ethanol industry and the ethanol sector. So our price relationships have shifted. And in my personal opinion, is I think by the time everything is done this spring, the numbers that USDA had will probably be a lot closer. I think we're going to come a little bit more increase in soybean acres. We're not going to plant as much double crop corn as what was originally forecast in that planting intentions report. So just to give you some, we'll be debating these numbers for quite a while. These are things that we need to be focused on from a supply-demand conditions. Again, I've got a lot more information we can go through, but I do want to take a break here now because I know I have about another, about 50 minutes or so that I'd like to talk about what's happening right now in the futures market and what signals the futures market's taking. So let's just take a short break. It looks like I've got potentially one or two more questions. Think about what you might want to talk about as we come back from break. So let's take about a 5-minute break. At about 9:15, I'll crank back up again and we'll talk more about what's happening in the futures market and using technical analysis to try and give us a better perspective on the future. So with that, I'm going to mute my mic. If there are some questions, I'll be happy to try and answer them. All right, it's about 9:15 here, so I'm going to try and get cranked up again. So we had another question that came in over the break. I want to try and address that because it's an important one. So the question is, if we pick up a few extra million acres of soybeans due to corn demand, to lack of corn demand, and Chinese exports return to a more normal level, what do you expect carryover to look like? So let me go back to this table right here, and let's just talk about that a little bit. So if we add, if the original forecast is right, if kind of we look at industry estimates at 85 million acres, I'm doing the math here real quick. So we're adding another 1.5 million acres of plantings times about 50 bushel yields. We got about 75 million bushels. So we'll add about 75 right here. Now, I did look back really quick. This 2 billion bushels of exports, our record high export, if we go back a couple years, was about 2.1 billion. So this is a 2,100 approximately. So that would be the record high. And again, given this number right here, this 2 billion bushels of exports, I think USDA's current forecast, their current estimates, suggest they are expecting China to come back and purchase soybeans very similar to what they have in the past. Again, we got to be competitive, price competitive with the South Americans, but their expectation is, given their forecasting, is they do think U.S. Soybean exports to China will return to levels very similar to what we've seen. So if we add another 75 million bushels in production because this planted acreage goes up, will we have some adjustments in crushing and export? Possibly, but more than likely, a lot of that will just drop down to the bottom line. So then all of a sudden, instead of 300 million bushels, you might have something closer to 375 or 400 million. So that would take us back up to a little bit higher levels, but not substantial. So I think the soybean market can handle a few more acres under the assumption that our crushing demand stays strong, which means that the number of animals left in the marketplace, the number of animals in the livestock sector don't change dramatically, and that our export sales return back to the kind of the levels we've seen in the Chinese market. I mean, those are two large assumptions. They're two big numbers, but it looks as though that might be possible. So I'm trying to give a little bit of optimism here. There's a lot of negative things we can talk about. And if we wanted to go into the downside, I can certainly give you a pretty horrendous story if we want to go that direction. And again, I don't think most people want to do that. So let me shift gears here a little bit. I'm going to minimize out of this, and I want to go back and start talking, shift gears a bit and talk some about charting and charting techniques. I am going to use the May futures contract for soybeans, the old crop. If you want to, we can talk a little bit about the new crop numbers as well, but I want to use the May contract as kind of our starting point right now, because I know there's still a lot of farmers that have old crop soybeans they're trying to figure out what to do with. And again, this is going to be a challenge. I am going to use DTN Profit X to go through this. At the very end, I want to save a few minutes to go through and show you you can do some of these, well, you can do all of these charting techniques that I'm going to show you on private websites. There's a couple that are free, and you can use these same charting techniques. I'm going to use DTN Profit X just because it's very flexible. I'm very familiar with it. It just allows me to do a lot of clicking very quickly to demonstrate the different techniques and how to do it. So at the very end, I will show you how you can log in or go to websites that offer these same capacity capabilities for free. I won't have complete time today to go through that and show you all the details of those other programs, but again, they're pretty self-explanatory. So let me pull up. I do want to show you, so this is the chart, historical chart for May soybeans. So the black line is the actual futures market prices. And I'm going to zoom in here just a little bit. I do want to show you that each one of these tick marks, each one of these lines represents some very important information. It provides about what's happened in the marketplace. So each one of the way it's set right now, each one of these lines represents 1 day of trading. The little tick mark on the left-hand side represents the first price as the market's open. And again, recognize right now with today's electronic trade, the market's open at 7 o'clock in the evening. This peak represents the highest price of the day. This trough right here, this low point, represents the lowest price during the day. And this little tick mark on the right-hand side represents the close of the day. That's the last trade as the markets close at 120. Now you will notice as I'm talking about it, these numbers of the number on the far right-hand side does change. So this is live updates. So the trade that I'm showing you right now is live trade. Again, this number on the right-hand side represents the most current transaction, again, where buyer and seller have come together. So I'm going to zoom back out a little bit. I want to show you some very basic techniques to look at what's happening right now and how can we use some of these different charting tools to say, all right, given what we see today, what do we think will happen as we move forward? So I'm going to start with some straight lines. I'm going to start with trend lines. The first trend line, I want to do a downtrend. So I'm going to click on here and draw some trend lines. I'm going to draw this one first. So notice what I'm trying to do on a downtrend. I'm trying to pick these high points. A downtrend is defined as when prices have spiked up, they reach a certain point and then fell down again. So when we draw a downtrend, I'm using the top part of these lines and basically the highs of the days to try and represent that. So this is a very long downward trend. Again, depending on how you want to draw this, the exact angles, I would consider this very close to touching the trend. We obviously have these points down here that have touched the trend line. I'm going to draw the same thing for an uptrend. And on an uptrend, what we're doing is we're looking at the bottoms, looking at the lows that have occurred and trying to say, okay, as these lows have moved upwards, as prices have moved up, they fall down to a certain point and then they stop. Based on today's numbers, again, this 850, which is the current market trade, it looks like we still have this uptrend. Actually, we could adjust this slightly. We'll wait to see what happens today. It is possible that this uptrend has now been broken. So what we say is we look for these spikes downward. We try and draw those lines in to say, all right, as long as the lows of the day do not fall below that trend line stays active. It stays viable. Now, this is a bit concerning because with today's trade right now is currently below that line. The blue line that we draw as the support. It's very possible that trend line has been broken. The longer downward trend line still looks like it's active. Okay, so trend lines are a very simple way of looking at what direction a price is headed, and are those prices going to stay in that direction? Again, this is a bit concerning that we see today's trade now below that trend line. So again, in a very technical charting sense, that trend line has been broken, so it looks like we're going to be starting to move lower. So trend lines are very simple. We're just looking for drawing the straight lines. I'll draw one more uptrend just to give you an idea of how to do that. We start at a point something like this. We start playing connected dots with those lows. So this is the uptrend. The uptrend is broken when we start to see the trade for the day drop below that line. Once it's broken, we say, all right, that upward trend has been broken. We're looking for a turn in the marketplace. So, and I'm trying to make this fairly brief because there's a few more things that I want to talk about. Really what we're looking for is indications that a particular trend line or a particular market movement, market momentum has shifted. So again, if prices are going higher, you as a farmer just want to sit back and wait. You don't want to price anything until you know that it looks like there's been a top in the marketplace. As a buyer, you're looking for the opposite. You're saying, well, if we have a downward trending market, when will that trend look like it's bottoming out and start to move upward? So these are just some different techniques that we can use to look for uptrends and downtrends. Another one that I want to show you that is very commonly used is support and resistance lines. And again, what we're looking for is we're going to draw and say, where have we seen historical lows? Where have we seen prices that have have dropped to a certain particular point and then started to rebound. So I'm going to start drawing some support and resistance levels. On the downward trend, it would be a support level. On the top, it would be a resistance level. So notice here we have a resistance level. We've seen a spike up on the marketplace. Prices have reached that peak and have dropped back down again. Now at this approximately this $9 mark, a little under about $8.97, we have a peak right here, but we also have a valley right here. So again, and that's typically what happens is when these become psychological barriers. So as prices have fallen, they reach a low, they kind of reach this psychological point with saying, you know, things have gone low enough. We see a rally. Now on the downside, as in this arena right here, we've seen a definite shift or break in prices. Prices started to rebound, and they rebounded about to that same level that we saw the low before. So now this $8.97 or about $9 becomes a real psychological barrier in the marketplace. If we start getting a rally in soybeans, how high will that rally go? And again, these will be some indications, some psychological barriers that we may be looking at in the marketplace. The first one, today we're trading at about 850. One of the numbers that I'm looking for right here is at about 870. Notice that 870 was the high right here in this day. It was also the high back here. We had very close to a low back here. So in my opinion, as we start looking at support and resistance levels, the 850 mark looks like it's a support level, at least short term. We saw prices fall down to about that 850 level right here. It looks like we're going to touch that 850 level again today. It would be worrisome to me if we see today's prices push lower and go below that 850 mark, because that then becomes a psychological barrier. If we break through that 850 on the low, the odds of going down to 820 are pretty high. I mean, that would be our next psychological barrier that we start looking at. So what I'm trying to get at is, if you look at the general downward trend in prices, we've had that downward trend in place for a while. When we start looking at what the support and resistance levels are, where are the psychological benchmarks that if we start to see a rally or if we start to see prices fall, where will we start to see some support on the bottom end or some resistance on the top end? These are the pricing points that I'm looking at as kind of these psychological barriers. At about 820 is the low, about 850 is kind of our next support level. We've been able to push through that. It looks like we're starting to fall down to those levels again. And 870, I think, is another number we need to be looking at. If we see some prices start to rally, is that rally strong enough to lift us through this 870 resistance levels? If we can get back to that support, that resistance level, if we can get through that, our next real barrier, I think, will be that about $9 mark. Again, those would be some pricing points that I think farmers need to be looking at and thinking about to try and make some old crop sales. I know those are not at the levels that anybody wants, but those are the levels that the market traders and those are the previous points that we look at to see those break points. If we can somehow get through that $9 level, and again, the next pricing point would be something in this 915 level, 910, 912. You could possibly look at this point back here, which is closer to the 915 level. Again, usually what we do is we take today's date, we start going backwards in time and start looking for these pricing points. So the 912, 913 would likely be the next pricing break. So this is one of those techniques. I've been doing this for quite some time. A lot of times when I talk to farmers and saying, where are some pricing points? What are some psychological barriers in the marketplace that we need to be looking for? This is a very simple technique that I've used in the past, and it seems to be one of those that holds pretty well. So again, it's a very simple technique. It's something that we can look at and saying it's not necessarily the prices we want out of the marketplace, but these are the pricing points where traders, both buyers and sellers, need to be looking for. So again, these are very simple techniques. Any questions about trend lines or support resistance levels when we look in kind of a static environment? In a few minutes, I'm going to jump to a bit more dynamic, or we call stochastics, where we start looking at moving averages and some other techniques to try and give us a better feel for not only what price direction, but also how much momentum there is, either an uptrend or a downtrend. So I'll take a short break here. Any questions? I know I went through that pretty quickly, but are there any questions on support and resistance lines or trend lines? All right, so with that, I'll delete these out, and we'll move to some other kind of analytical techniques that are commonly used. So another one that I want to do, I'm going to do an add study here. One of these that I want to talk about is a Bollinger Band. And so I'm gonna give me just a moment here. I want to change and brighten this up so it's a little easier for everybody to see. Just give me a moment, and you should be able to see the different colors here, and we'll talk about what those lines mean. I'm going to change the color of that. That's just very difficult to see here. Give me just a moment. That was the wrong one. I'm sorry. Let's go back to the green, and we'll change this one to blue. Apply. There, we got it. Okay, so we have three lines that are being put on here. We got a green line, a blue line, and a red line. So the blue line is a moving average. So that's a 20-day moving average. So how do we calculate that? It's actually pretty simple. We take the closing market price for each day for the last 20 days. We add them up and divide by 20. Tomorrow, what we're going to do is we're going to add one day, we're going to subtract one day. So as we move through time, every day we're going to add one day and we're going to subtract a day, so that we recalculate that moving average. So what the moving average does is it also provides us a general indication of the trend line. So what is the trend? Again, we're looking at a downward trending market. It looks now like the last couple of days, it looks like this moving average is starting to tick upwards a little bit, which again would be a positive sign that it looks like on average our prices now have bottomed out. We might be seeing a slight turn or corner in the marketplace. One of the other indicators we start looking at is people will also use these moving averages as also either a support or resistance level. So if you notice now that we did see for a couple of days, the high of the market started touching that upper boundary of the 20-day moving average. So it acted as a resistance level. Now, the last 2 days we did break through that. So that was a positive signal that, okay, it looks as though the trading right now is above the 20-day average, that we've broken through that psychological barrier of the moving average. Now today, again, it looks as though we've fallen back down below that. Again, so if we look at today's numbers relative to the moving average, we're on the bottom side of that. So that is also indicating, even though the moving average looks like it's starting to kick up a little bit, the fact that we're trading below the moving average today is psychologically, or at least from a technical standpoint, not positive. It looks as though we might be moving. Again, there's a shift in the marketplace. The new information that we've got today is indicating that we might be seeing more of a downward trend, or that downward trend may be continuing. The green line and the red line provide some ranges, some boundaries for us. And I don't want to get into too much of the math for it, but basically we're also looking at not only what is the mean, what is the average, but also what is that trading range. And one of the mathematical tools we use to determine how variable our markets is called the standard deviation. And you probably learned that back in high school when you went through some math classes. You thought, oh crap, I'll never use this again. But guess what? We're going to use it. So when we take not only the average, but in the last 20 days, what is the standard deviation? So what's the range of trading? And if the standard deviation is high, if the distance between the green and the red line is very, very wide, it means prices have been extremely volatile. If we look back here where that distance from the green line to the red line is relatively narrow, it means that we have a really tight trading range. So what this is signaling to us is that, yes, in the last 20 days, we've had a lot of volatility, which again is not surprising to anybody. Now, we use this range as also an indicator of where is that, again, another support or resistance line. So if we look back here, if we look at what was happening during the middle part of March, we not only saw that prices were dropping and dropping rapidly, but they were coming very close or actually breaking through this bottom resistance level or bottom support level. So that was a very strong indication that we have a downward trend, that downtrend is happening rapidly. Now it looks like, again, based on our moving averages, it looks like we have a support level at about the 820. So again, when we did the straight lines, it looked like we had about an 850 and then potentially about an 820 number. This 820 number is now also showing up in our moving averages. So our support level is also looking, we're coming in at that 820, 825 level based on this moving average. So again, when we have two indicators telling us basically the same story, in my mind, my interpretation of that is we got some very strong support on the bottom end at about 820. We have, again, based on this technique, we have kind of this trading range between about an 860 and about an 825. Looks like we're starting to trend lower, but we're on the bottom end of that. We're below the blue line, but it looks as though, again, the support level would be at about 820. So we have a fairly wide trading range here based on this technique. So based on this signal, it's confirming that we have some downward momentum. We're in the bottom half. We're between the blue line and the red line. If we do start seeing some drop to the bottom, this 820 seems as though it's going to be a support level for us. Any questions on this Bollinger Band idea? So we use the 20-day moving average as also, again, of that support and resistance level. We also look at these boundaries, the upper boundary and the lower boundary, and kind of what shape is that giving us, but also kind of what is that signaling for us for a support and resistance level. So again, this is confirming it looks like we're having some downtrend or downward pressure in the marketplace. Consider previous years, May soybean futures. Does this follow any historic, or is this COVID-19 trading? You know, if we were to do a long-term, so let me zoom back out here a little bit. If we look at this May trading, I'm gonna stop at about there. This trading pattern, this technique, does work historically. This is a very common trading or a common analytical technique. It's used a lot in the energy markets for energy trading. So it is a common tool, and I want to emphasize that it's one of many tools that we have in our toolbox to evaluate trading. So I wouldn't consider this to be a technique that is only a COVID-19 technique. I think it works in other types of markets, and we've seen this. We saw some similar kind of activity when we had the trade war going on with China. Let me just minimize for this for just a moment. Let's use the same kind of technique on November soybeans. So the question is, if we look at November soybeans instead of May soybeans, what is this telling us? Okay, so when we look at new crop soybeans, I'm going to zoom out here a little bit. Again, we're getting a similar pattern where it looks like the 20-day moving average has started to tick up. Right now, the blue bar or the blue line is being viewed as a support mechanism. We have a short-term uptrend in May in new crop soybeans with again continuing a long-term downtrend. If we looked at straight lines, the blue line is considered a support level. We're touching that support level, so again, we're getting some. It looks as though we've got an uptrend because we're above the blue line, but that blue line is sagging lower. Today's trading is in the top end of the range. We're between the blue and the green. So we are, again, short-term in an uptrend, but it looks like it's starting to soften. So will today's November soybeans drop below that? If it does, that would indicate that there is a shift in the trend line or shift in the psychology to more of a downtrend instead of an uptrend. I don't know if that made a lot of sense. I did a very poor job of explaining it, but so the signals from new crop soybeans are a little bit different than old crop soybeans. Old crop soybeans are more negative. The new crop soybeans, what is signaling is that we've had a short-term uptrend, but that uptrend may be weakening. So let me go back to May. What I'm gonna do, and I want to make sure I explain this correctly. The techniques that there's a lot of different charting techniques that are available. There's a lot of different people use different techniques. Think of these, the analogy I like to use to explain it to people, think of this as different gauges on the dashboard of your combine or the dashboard of your tractor. Each one of these gauges tells you something a little bit different about what's happening in the marketplace. Some of those gauges are very, very sensitive. They change very, very quickly. Their response time is very fast. Others are much slower moving. They're important indicators, but they're slower indicators to move. So let's talk about the tachometer versus, let's say, the fuel gauge. You know, the fuel gauge on your tractor, your combine is important. It doesn't move very quickly, but when it gets down into a critical range, it's something that you need to pay a lot of attention to. Versus the tachometer, it changes very, very, very quickly. It's very sensitive to changes in the marketplace or the changes to going on as you're using your tractor or your combine. So just like that, we have very sensitive indicators in the marketplace, and we have some slower indicators, some that are that we can use to get a better longer-term perspective on what's going on. So let me add one of those slower moving ones. That it's also very important. It provides us a signal about what's happening in the marketplace, but it's a slower moving one. And that would be the RSI, Relative Strength Index. Let me see if I can find it here. RSI right here. I'm going to do that. I'm going to add that. So the RSI, and again, you'll see a relationship, and because it's a mathematical relationship, Relative Strength Index is a ratio. So it looks at the number of up days in the market and how quickly the market's moving upwards versus the number of down days in the market and how quickly prices are moving downwards. So it's a ratio, it's a percentage. So and we use a 0.5 or 50-50 as neutral. So a neutral number is where we have equal number of up days and an equal number of down days, and those movements balance each other out. So if you notice, if we look back historically here, I'm going to shrink this up a little bit and look back historically, it's very rare for this indicator to get to 20 or below 20, and it's very rare to see it up near 70 or touching 80. So this provides us an indication of kind of movement, you may have heard the term overbought or oversold. When we start seeing a downward movement in prices, and we see this downward movement here that we saw about a couple weeks ago, this RSI started going down, and it's unusual for it to get below 30, and it's very rare for it to even touch 20. So we see this indicator getting below 30 and close to 20. It's an indication we've had a very strong downward movement, and that downward movement, it's very unlikely that it will continue. So as we see this RSI reaching 20 and start to move upwards, it's an indication that our trend, again, it's another way of thinking about a moving average, the momentum in the marketplace is starting to shift, and we're seeing an upward movement. Now again, we saw an upward movement coming into the neutral zone. We're seeing this starting to drop now and flatten out at about a 40, which means that we still have downward pressure in the marketplace, but it looks like that downward pressure may be stabilizing. So again, this is one of those indicators that doesn't move quickly, but when it does move, you need to pay attention to it. So again, given the time I have left, let me add one more. Actually, this is one that I like to use quite a bit. It's MACD, it's the moving average convergence divergence. It's this one here. I'm going to add that one and we'll talk about that one. So we'll look at all three of our gauges simultaneously and kind of give us an idea of what are these different indicators saying about what's happening in the marketplace today, especially for old crop soybeans. So what I really want to focus on is these red bars, the red bars. Now the red bars actually represent the difference between the blue line and the red line. So these are, the red line and the blue line are moving averages, just like the blue one we see above, just like this moving average. But these moving averages are a little bit different. They are weighted moving averages. So instead of a simple moving average, this is a weighted moving average. What we're looking at is, if we take a simple moving average, what we're saying is that the information contained in that 20-day period has equal weight. So what happened yesterday and what happened 20 days ago has equal weight in the market. With this MACD, the one that I'm looking at right now, those moving averages are weighted. So what we're saying is, it's like the market has a memory. So the information contained in what happened yesterday is going to have a much higher weight than what happened, let's say, 20 days ago. We're still going to include that information in our analysis, but we're going to have a much lower weighting. So let's talk about how are you going to interpret. I'm not going to worry so much about the math, but how do you use this information to try and get a better feel for what's happening in the marketplace? So notice it looks as though these histogram, or the red bars, move in a cyclical pattern. Again, the cycles down here follow those cycles that are happening in the marketplace up above very, very closely. And again, that's for a reason, because it's mathematically connected. So how do we interpret this? If the red bars are below this middle line, if we look at, and let me see if I can zoom in a little bit, make that a little more aggressive. What this is signaling is that if the red bars are below that line, we're in a downward trend. And the size of that bar is an indication or a measurement of how aggressively are we moving lower. So what happens is we move into a downward trend. That downward trend is gaining momentum. So that height of that bar represents how fast we're going down. And as we move closer to that zero mark, what it's saying is that we're still in a downward market, but the momentum is starting to slow. So we went from a downward moving market to an upward moving market. So these bars now are representing we are in an upward moving market. That upward movement is gaining momentum, and we're still in an upward market. But again, as these bars get smaller, it represents that upward momentum is starting to wane, that we're still moving upward, but the rate of change is starting to slow. So as we move and we look at this indicator, again, this is really a very solid indicator we're in a sideways movement. We're not really moving upwards. We're not really moving downwards. This is in kind of a stable or sideways moving pattern. So based on this MACD indicator, it's telling us we're probably in a sideways pattern. The blue bar, the RSI, is saying we're probably in a sideways pattern, so slightly downward moving. We've got this moving average here saying we're starting to flatten out. It looks like we're in a kind of a sideways pattern to a slightly downward trending pattern. So again, all three of these indicators are telling us something similar, that we're probably sideways to slightly lower in old crop soybeans. So let me shift. I'm going to do new crop soybeans. We'll go through this same exact analysis. Okay, so let's look at what's happening in new crop soybeans. When we look at this Bollinger Band, it looks as though we're in an upward trend. It looks like it's stabilized. We may be tipping upwards. The current trade is above this support level. So at least that support level is providing us maintaining that upward trend. When we look at the RSI, it's relatively neutral to slowly growing or slowly upward trending. When we look at the MACD, what this is signaling is that we are in an uptrend, but that uptrend may be losing some momentum. So for new crop soybeans, it's a slightly different pattern than old crop soybeans. So again, to me, this is signaling that yes, the mentality or the psychology of the marketplace is different between old crop and new crop. Again, old crop is going to be much more sensitive to what's happening within the livestock sector, what's happening within the concerns about feed and feed demand. The new crop soybeans are saying, yeah, we're concerned about that, but this to me is signaling that they don't believe that this downward pressure and meat on the demand for soybean meal and soybean oil is going to be as strong as it is for the old crop, if that makes sense to people. I hope I'm explaining that well. I would like to click really quickly. Let's look at what's going on in the soybean meal market, because I know, again, for profit margins on oilseed crushing, again, a major sector for us, we're seeing some pretty negative things going on in the soybean meal market. And again, a lot of this is because of the pressure being put on the livestock sector and livestock profitability. If we look at soybean meal, nearby soybean meal, definitely in a downward trend. We're starting to see this moving average tip over. We're in the bottom half of the range. We're seeing the RSI, this indicator, moving downwards. We're also seeing on the MACD, we're looking at a downward moving market. It looks as though that downward momentum might be slowing a little bit. We're also seeing, again, this RSI, when it gets down to 30, it's unusual for it to go below 30, but it can. 20 is kind of our trigger point to saying it looks as though we may see that might be the low. So again, how long will prices fall? It looks we're definitely in a downtrend for soybean meal. We don't know exactly how far it would fall, but it looks like, again, one of the measures we're going to use is this red line, is that providing that initial support for the downward trend. So again, on the meal side, a very strong downward movement. When we go to soybean oil, at least nearby soybean oil, we're having a little bit more stability in the soybean oil. Let me move this up. Try and zoom this out. On the soybean oil standpoint, again, we're in the upper part of the range. This blue bar is going to provide that underlying support. It'll be our support line. We're looking at a relatively neutral position when it comes to this indicator, which is the RSI. It looks as though we have been in an upward trend when it comes to the MACD, but that upward trend may be starting to slow now as we get some of these indicators starting to turn and tip over. All right, so I know that was a really quick, brief explanation. Are there any questions? I want to make sure that we end on time. Any questions about the technical indicators and what the technical indicators are telling us? I do want to show you very quickly in the couple of minutes that we have left, how can you do this on your own? Where can you go? Again, I got to be very careful that I don't recommend one company over another company, but one of the ones that has been around for a long time that I myself use periodically is called Bar Chart. So I want to go show you how to get there. barchart.com. Okay, so barchart.com, no S, just Bar Chart, because there's another company, again, another good company, but it's another company that uses an S. So let's just go barchart.com. This company has been around for a long time. When USDA collects data for price discovery for crop insurance, they get their data, they get their information from Bar Chart. So how do we find the grains? This is a company that provides information about a lot of different markets, futures markets that are trading. To find the soybeans, you need to go to futures. So if you click on futures, we want to come over here, go to grains, and it'll automatically shift and the grain markets will come up. So they're going to give some of the most actively traded markets. Again, this is a free, you can sign up for a subscription that allows you some more flexibility, but it's free. It provides a lot of the charting techniques that I just showed you. If we go to May soybeans, simply click on May soybeans. And the information for what's happening in the soybean market's going to come up. It'll give you all of the different contracts that are available. I want to click on May soybeans again because I want to get to the charts. I want to get specific information about what's happening in May soybeans. So it provides a chart right here. You slide down a little bit, and it'll provide some information about what's going on in that market, kind of some market summary. I want to go back up to the chart. So if we go to full chart, this is what I wanted to show everybody. This is a free service, so you can come in here, and on the very top, this will give 6 months. You can go to 9 months or 1 year. If you want to click on 1 year, this will give daily price information for the last year. If you want to go to tools, you can go to drawing a trend line. And with the trend line, you click on the start point and you draw the line, and you click on the end point, and it'll give you a trend line. If you want to go to a study, click on a study. Here's Bollinger Bands. You click on Bollinger Bands. You say add. Yes, I want to add a Bollinger Band. And it comes and it provides you information about the Bollinger Bands. So it'll do all the math for you. You don't have to worry about it. Again, this will provide the same information that I did to you earlier. It'll give you the same charting and charting techniques. If you want to go to MACD, click on study, scroll down to moving average. You got to slide a little bit further down here to MACD. You say add, it'll add that to the chart, and you can add that to your analysis. So here's the MACD, and you can print this out if you wish. I'm going to close this for right now just because it'll make it easier to see. So again, you can see some of the charting techniques that are available for free. Again, these, you don't have to pay a lot of money for them. If you do sign up for a subscription, you add some more flexibility. So we have about 1 or 2 minutes left. I know I've been trying to, I unfortunately had to go through this fairly quickly, but I wanted to provide an overview of what is the market telling us right now. Nobody knows exactly what's going to happen in the future, but this does provide some indication about some techniques and tools that professional traders use to try and get a better handle on what might be happening in the future. So are there any questions as we try and wrap this up in the last couple minutes? You can either unmute and talk, or if you want to type something into the chat box, I'd be happy to try and answer questions. Again, we'll have some more time together on, Bill's going to come in tomorrow and talk about basis and what's happening in basis levels. On Thursday, I'm going to come back and we'll recap some of this stuff, but also talk some more about the different tools we have in our toolbox and some of the techniques that you might be using as we move forward in time to try and put an actual marketing plan together and implement that plan. So we'll have a bit more time on Thursday to talk about what's currently happening in the market, but also talk more specifically about strategies that you might want to put in place. Are there any questions as we wrap this up? I will stay on the line for a few extra minutes, so if somebody wants to either talk individually, or if you do have some extra minutes and want to type in some questions, I'll be happy to do that. Anything from anybody at this point?
Hey, Frayne, this is Jenna. I think there's a question in the chat box if you want to check that.
All right. So, okay, let me move my things around a little bit so it's a little easier for me to see. Okay, so do you expect the bean market to bid for acres compared to corn as we get closer to planting? It appears the market is telling us not to plant corn or beans. Well, yeah. So one of the things that I have been following and watching, and I'll try and for the session on Thursday, I'll get some more information pulled together for you. One of the things that is commonly used at this time of year is looking at that price ratio, the relative prices of corn versus soybeans. You've probably heard a price ratio of like a 2.5. So if you take the soybean price divided by the corn price, 2.5 is considered neutral. 2.4 is considered to be positive, and the market's trying to encourage more corn plantings. And a 2.6 is where the market is trying to encourage more soybean plantings. Now, the last time I checked, which was yesterday, that price ratio for November soybeans divided by December corn was a little bit over a 2.5. If we were to go back in time and look at that price ratio when that planting intentions report was when the survey was done, if we look at the first part of March and what farmers were looking at as far as a price ratio, what was the futures market trying to encourage farmers to do? At that point, that price relationship, that price ratio was well below a 2.4. In fact, it was close to 2.3, 2.35, which was a very strong signal that the market was sending at that time. Yes, we want farmers to plant more corn. The price incentives at that stage was for more corn. And I think the planting intention report indicated that farmers were looking at those numbers and saying, yeah, you know, based on their price relationships, based on my budgets, looks like the market wants more corn, so I'm going to plant more corn. In today's world, once we got that information from the Prospective Plantings report, and farmers said, yeah, our intentions are to plant something close to 97 million acres, all of a sudden those price relationships shifted, and they shifted pretty quickly. Actually, they shifted back to more of a neutral position, something closer to 2.5. When I interpret those numbers, what it's saying is, yeah, we need some corn. We think the corn acres need to get planted, but the incentive isn't nearly as strong right now. So they're saying that corn farmers, you may have overdone it. We're not going to provide you a price incentive for planting corn on corn. As you get close to a 2.4 ratio, that really is an incentive to plant corn on corn over soybeans. Right now, it's much more neutral. I think the market is saying we do want more corn acres, but don't overdo it. That given the concerns and worries about the ethanol profitability, about the amount of corn that may go into the ethanol market, not only in old crop, but also new crop, that there is some concerns about the ethanol sector as well as feed demand, and that we may have overdone that corn plantings number. So right now, the market is much more neutral. It's saying we want a good balance between corn and beans, and they're not providing that incentive for hardcore corn on corn planting. So yes, I do think the market is signaling to get more of a neutral balance. Don't overdo the corn and plant a few more soybeans. So let me see another question. Will the recording be sent to us via email? I've been having a difficult time focusing while trying to take care of the kids. Thanks. Yes, I'll send a link. This will actually be because of the size, the file size. We'll send you a link to a cloud site that you'll be able to listen to everything. And again, you can work through the Soybean Council, either through Jenna or through Stephanie Center, and we'll make sure that gets out to you. When do you think that comparison ratio, what month of trade are you looking at? Nice job. Enjoyed today's outlook. Okay, so what we're looking at, and again, that ratio is typically only, I guess, most important at this time of year when we think about planting intentions. And usually we use the November soybean contract divided by the price in the December corn contract. Once the crop is in the ground, that ratio can do kind of whatever it wants to. But right now, today, the ratio of November soybeans to December corn is trying to signal farmers what kind of a balance do we need? What kind of a balance does the market want between corn and soybean acres? So again, those are the numbers that I'm looking at. Again, one more time, it's November soybeans divided by December corn. A ratio of 2.5 is considered neutral. A ratio of 2.4 is really incentive to plant a lot more corn, and it's really providing an incentive for corn and corn. If we get to a ratio of 2.6 or higher, that's a real strong incentive for farmers to plant more soybeans. Any other questions? Anything else that, again, you can either type in the chat box, or if you want to unclick and unmute yourself, I'm happy to try and answer questions that way too. All right, well, hearing nothing, really appreciate the insight. So thank you for your comments. And again, if you have any questions, if you think about something later on, feel free to send me an email. My email is on my first slide. You can also just Google my name. It'll come up. I'm the only Frayne Olson around, so I'm not that hard to find or track down. So if you think of something later on, I'd be happy to try and answer more questions on on Thursday. Again, just as a reminder, tomorrow morning, Bill Wilson will be on. I'm going to help get him started and get him going. I'll be available for any questions also. Tomorrow morning, 8 o'clock, Dr. Wilson will be on talking about basis and not only historical, but also the trends that we see moving forward. So thank you very much, and I'll probably sign off for right now and stop our recording. If there is anything later, please let me know. Thank you, and have a great day.